You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
It is a dangerous world out there. Volatility is on the rise, and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the SIBO over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit orats.com or email Matt Amberson at matt@orats.com. And now, it's time to learn how to implement options in your practice. It's time for the Advisor's Option.
All right, everybody. That music means we are back once again for the Advisor's Option, the program out there for you, the busy financial advisor or asset manager. You want to learn more about these options things. I'm guessing a lot of your clients are probably asking about them right now, but maybe you're a little bit concerned, a little bit intimidated. You've heard some scary things about options. Maybe you don't know where to start. Well, you came to the right place. We got you covered here on the Advisor's Option. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-scintillating network upon which so many of you are binging these days. Remember, of course, if you want more in your life, and there is more to be had, not just the nearly a dozen shows on the network, we also have more coming at you, of course, if you want to engage live with all of our programming, ask questions directly to a lot of our guests and our hosts, participate in great pro Q&As. For a lot of the audience of this program, we've had a lot of great guests who could really help explain the world of options to you in even more detail. And, of course, unusual activity and a whole bunch more. TheOptionsInsider.com/pro is the place to go to learn more about all of that. And, of course, keep those questions and comments coming. We do love to hear from all of you folks out there. Let's see who we're hearing from on the old program today. I am pleased to be joined once again by my compatriot, my partner in all things Advisor's Option crime. He is Mr. Matt Amberson, the founder over there at ORATS, a.k.a. Options Research and Technology Services, a.k.a. known around these parts as the Oracle of New Hampshire, for his prescient call early on in the pandemic that there might be something to this vol. We'll see if we can get some more prescient calls out of him today. Mr. Matt, welcome back to the Advisor's Option program, sir.
And we saw each other, so we both know that we exist.
Yes, I can confirm life. He does exist.
So that was, we've talked to each other since in the fall views, but Options Advisors is the first time that we're talking since we've seen each other live. We had a fun time together at the old industry conference. So it's great to see you, Mark, and hopefully there's more in-person events coming up.
What's the old saying? Once you've shared hot cheese with a man, you are bonded for life. Yeah. Isn't that the old saying? It was a good time.
A good friend when your friend's lactose intolerant and I order melted cheese for the whole table.
Hey,
so
I lived vicariously through all of you. It did look and smell delicious. So I was 2/3 of the way there. And speaking of 2/3 of the way there, we're supposed to have a third on the show today. We're going to be joined by our old buddy, Mr. John Cherry from Northern Trust. Of course, these are crazy markets. Last minute, they had some client emergencies come up. We'll work to get him rescheduled back on the show to get a glimpse into what's going on over there on the broad asset management side. They do manage a lot of assets over there at Northern Trust. Always fun to get a glimpse into what's going on over there in these types of rocking and rolling markets. Speaking of rocking and rolling markets, let's get to it. It is time for the P&L statement.
What the heck happened in the options markets since our last episode? Let's find out with the P&L statement.
All right, everybody. Welcome to the P&L statement, the portion of the show where we break down what the heck's going on out there in these crazy markets, what has lit up our screens and our tape from a overall market and indeed a volatility perspective since our last show. And pretty much, it's pretty straightforward for the most part. From the broad market perspective, it is mostly down. We've had a few days bucking the trend, today being one of them. S&P up slightly today, but net we are still down since our last show. We were north of the 4,000, substantially north of the 4,000 handle on the S&P on our last show. Coming into today's show, we're at about a 39.50, and we have dipped, of course, much lower than that in the intervening period. So a lot of people out there doing a lot of hand-wringing in terms of markets. What's going on? Is this the sell-off? We are flirting with bear market / correction territory, depending on which index you're looking at and the time frame you're looking at it in. Of course, vol has remained frothy. Some people think maybe not frothy enough. You know, we saw some pretty aggressive sell-offs, particularly last week, bordering on 4% intraday, and yet we saw VIX and other vol measures struggling to really break that far north of 30, which has surprised some folks. So a lot to unpack there, Mr. Matt. A lot has happened since our last show. Mostly red on the market side and mostly green, but mildly on the vol side. What's been lighting up your tape since our last show, sir?
Yeah, it's certainly an interesting market, but I've made some calls, and I'm going to stick with them. It reminds me of 2018, and the actual top to bottom is about the same in percentage terms. And then, and I also said, the somewhat obtuse call that contango is saving this market, and it is. So the what you'd normally see with vols this high is a backwardation where the front months get a lot higher than the back months. But overall, right now, and we look at 20, 30, 40, 50 to 90, those are getting pretty flattened out. So that's what I think is supporting or some support or showing signs of support for the market. The implied volatility is still a little bit in precarious land, meaning it hasn't really broken out of its uptrend. So generally what you want to see is, if you're bullish on the market, is vol coming down a bit as they move in opposite directions. Contango moves in the same direction, and my ORAT's flat vol versus calculated forward volatilities move in similar directions. Those are still kind of in a downtrend. So we have conflicting signals, I would say, but some of the momentum and the contango is giving some support. I think we're still in for some rocky rides, but it's feeling like we've established a bit of a base. There's some argument for it being, just about the same as the 2018 before the Fed stepped in. So that's what it's seeming like to me. I've been doing these, I've jumped on the bandwagon market. I always have an interesting trade that I'm testing out / doing, and now it's the 0 DTE SPX calendars.
Oh, were you inspired by Henry's presentation down there at OIC that some ridiculous percentage of all trades were on the same day of expiration? Yeah.
So I was doing that, got a chance to see Henry, and good to see him. And yes, he had very prescient comments, and we're really seeing a lot of that short-term trading strategies, and a lot of our customers are asking for it. So I decided to start pointing some of our resources at ORATs towards signals, towards back testing of intraday, and so before I give it to our clients, I usually test it. So it's been doing pretty good. So I guess the long story is that those 0 DTE wouldn't do that great unless the market was at least within some ranges. The historical volatility is still well above the implied volatility from a 20-day basis, but that's starting to come down as well. So hopefully that gives everybody a feeling for what I think the market looks like right now, Mark.
Walk us through quickly. What are you talking about with this zero? What is the strategy? What are you executing with 1 day to go or less?
Yeah, actually, you can't call it a 0 DTE if you're a calendar, right? So it's a calendar using either a 1 DTE or 0 DTE as the short side, and you're buying the long side, 2 or 3 or 4 days out. So it's usually a 3-2 or a long the 3 day, short the 2 or 3-1, something like that. So it's been an interesting trade. It's been working pretty good. And then I put a little bit of protection on each side. I don't want to freak anyone out, but so if you have the protection that I do, so if you're long the calendar, you're actually long some Vega, and you're not long a lot of Vega, but the Vega is moving around a lot. So I do a put iron condor that where you sell closer to the money, buy slightly more out of the money, and then buy the puts. So you're selling a put spread and then buying out of the money put spread. So that gives you some short Vega on the day of the long Vega, and then buying an iron condor, a true iron condor, on the short side. So that helps you if it moves a lot. So it's a calendar with some protection.
Wow, a lot of moving parts to this zero DTE trade.
Yeah, well, you got to, people don't understand the risks involved. They say, I'm just going to do this or that. If you're doing a calendar, there's a fair amount of risk. There's Vega risk and there's there's movement risk. And so, if you really want to kind of hedge a lot of those out I could go to, because often the zero DTEs, what people like it is they, think, oh, I don't have any overnight risk, but but the market's been moving so much intraday, they have a lot of intraday risk. But if you have overnight risk, I like to put a little help in there for me, so I don't have to worry if the market goes big one way or the other with all that, with all those 2 iron condors plus the calendar. So, it'd probably take a while to explain, but it's helpful for me. It's been working, and our testing, our signals testing, and our scanning is just finding all these great trades. So it's fun to do it in our new dashboard product. So yeah.
I was joking when we saw the advent of these new daily expirations in SPX, and I'm sure soon to follow suit in other major indices, that we're going to see a new era of intra-day, intra-week calendars, really. Your Tuesday, Wednesday calendars and your Thursday, Monday calendars, but you're already ahead of the game, Matt. You're already in there slinging the intra-week calendars with a whole bunch of other elements on the side, sir.
Yeah, and we get a lot of queries from our clients about these things, and I go, what is going on? And there has to be something going on, and lo and behold, there's some videos about them. There's some, but no one really does the back testing. They're just saying, this looks like a good trade. I'm like, okay, let's test it out, and so I found some good sweet spots and found some good ways to protect it. And so it's still a work in progress. But, with this market, that's a short gamma position and still working. So, this is it's interesting market in that respect where, COVID went straight down. This one is just kind of lingering going down with high vol. So it's an interesting no bear markets are the same, but this is an interesting bear market.
Yeah, we have a poll that kind of touches on that. We'll get to that a little bit later in the show. It's already prompting a lot of discussion and debate out there, which is the point of our poll questions after all. But now let's keep on rolling. Earnings have been driving a lot of the vol that we're seeing out there in the broad markets right now. So let's get to the earnings volatility report.
Earnings announcements can move markets, but what is the options market telling us about upcoming earnings events? Let's find out with the Earnings Volatility Report.
All right, everybody, welcome to the Earnings Volatility Report, the portion of the show where we do just that. We break down what's going on the earnings volatility front. Let's see how the season is shaping up, break down some trades, and a whole bunch more. Of course, Matt and his team, when they're not talking to you guys on a show like this and doing a lot of fun back tests, they're also crunching a lot of data for you guys in terms of earnings season and how it may impact your portfolio, how it's playing out right now, how it compares to past seasons, and what you can do about it in terms of earnings trading. So a lot to unpack. 4 great reports we have for you, updated all the time, multiple times per week for you over there at theoptionsinsider.com. That includes the earnings move. So that's what is being priced in terms of overall earnings straddles, how it compares to history, the earnings move results, so how it actually worked out. And then, of course, the earnings season, where we break down the entire season from a vol perspective and let you know week by week exactly how it's lining up, how it compares to historical. And if that's not enough, if we didn't like you folks enough, also the earnings trades reports with a lot of great earnings trades going on out there. It's another hot week as we're coming into showtime here, the tail end of May. Big names popping off still this week. Of course, last week we saw just the retail wreckage in terms of Walmart and Target and just about every other big box retail. I think with the exception of BJ's, just turning to the dark side. This week, that trend has mostly continued. Best Buy was popping off this week. Zoom Video on Monday. Nordstrom, maybe the other sign of hope, glimmer of hope in the retail space. Whereas if you target the ultra high end of the retail sector, apparently they're doing all right. They're still spending. So Nordstrom's doing all right. Just about everybody else on the retail front not looking good. Dick's was before the bell this morning, also not looking good for them. Not a lot of sports equipment sales going on out there. Nvidia today, Snowflake, they're an interesting one. They were a hot IPO for a hot minute. Haven't heard a lot about them since. Maybe today's report will gin up some interest out there. Tomorrow we got Alibaba and Macy's and Dollar General and a whole bunch Friday. Big lots. So a long way around to saying there's still a lot of earnings vol to analyze. Mr. Matt, we are kind of coming into the tail end of earnings season, sir. What has been catching your eye? What are some of the trades and trends and highlights that have stood out to you this season, sir?
It looked like we were going to be going straight up for as far as the owners of vol, but when it gets this volatile in the market in general, it doesn't usually bode well for making money on the earnings straddle, and that's exactly what we saw earlier. We had a 105 in there, meaning the straddle owners won that 1 week, but they've lost all the other weeks. It's a 6-week earnings season that we look at, and generally what we see historically is that weeks 4 and 5, sometimes 3, are pretty much pay for themselves, but the rest of the weeks are pretty costly to option straddle owners. ORATS has a method where we look at the straddle, look at how many days are left, and do a distribution of expected move at announcement, take that out and value the straddle for the number of days left. And then so we could really hone in on what the market is expecting for the day of or the announcement day. And we compare that to the actual moves, and we do that in aggregate. And we separate those into the weeks, and we could break them down from there. So it's pretty consistent, which is, if you're a trader around earnings, you definitely want to watch the earnings season. But this earnings season is underwater again, and it's the last earnings season has dragged down the overall the last 12 weeks. So we're right at average. So 12% losers for the owners of the straddle is what we're seeing now. And as you said, Mark, we come out with other reports. One of the ones that I think is fun is the trades report. So we've gone back and back tested these. Mostly it's a calendars. We like the calendars a lot safer and the best performing. Although this particular earnings cycle hasn't been that great, and I'm regret to say that I was on one of the worst ones. Was it Ross Stores that just got pummeled? So that
I thought you were going to say Snap yesterday. They got annihilated pretty badly too.
Yeah, no, we actually had a signal for Ross Stores, and that came out. But overall, we're kind of at a break even this season. But usually, we're doing pretty good about making about 1% of the stock price. So that's a pretty good result for the calendars. We had Dick's, and Dick's went up a little bit. I'll have to check it out. But Dick's, the calendar made some money, made it $1.50 which is 2.1% of the stock price. So that's the earnings trades, and then we follow them out through the various seasons, and you can follow along with those. And then we have the earnings move results per the day. Cal moved at 233% of its expected move. I hadn't heard of Cal, but it operates under Famous Footwear. I don't know if anyone knows that one, but it's up 27% today. That's the biggest mover on the board in our earnings results. So we compare the results with what we expected. And as far as the expected for coming up, NVIDIA is coming up, and they're after the close today. The market is expecting a $16 move. NVIDIA is $161, so it's a 10% move. Usually in the past, it's only been less than half of that, about 4.5%. So very high expectations for NVIDIA. As you mentioned, Snowflake, very high expectations. All of these have just much higher expected moves than normal. This is the pricers of these straddles are really putting a lot of premium there, and probably for good reason. But people may be buying them, but they're certainly not getting the returns out there. So there are opportunities. It's been interesting to watch, interesting to maintain these reports, and it really gives you a good overview of what's going on. So that's what's going on in the market in these last few weeks of earnings season, Mark.
Yeah, earnings season going out with a bang, not a whimper, Matt. A lot of names bringing a lot of vol these days. It has been mostly macro, but lately it's been a lot of single-name earnings-driven vol driving the market. As Matt mentioned, if you look at the earnings season report, listeners, we are hovering right about at that average. The average for the past 3 years has pretty much been about 88% when you average all the weeks together. Right now, we are hovering at 89%. How does that break down? Week 1, pretty apocalyptic, 65%. That means if you bought a basket of all the various straddles out there, if they returned exactly what they priced in, that'd be 100%. At 65%, you're getting about 2/3 of your money back. So obviously not a great trade. Week 2, a little better, 75%, still terrible. Week 3 was the banger of the cycle at 107%. So you actually made some money if you were buying premium. Then week 4, 89%. Week 5, 95%, all averaging out to 89%. If you want to see that for yourselves, you know where to go, theoptionsinsider.com. Click on the Options News and Articles tab. You'll also see there some of the upcoming earnings reports. You can see what names are still to come, what they're pricing in. You can see the results reports, or how names have performed that are announcing right now or immediately before the report was issued. And even more interestingly, if you want to see some ways you could potentially approach this in your own trading, Matt and his team, as you mentioned, kind of breaking down some cool strategies you could at least watch and keep an eye on in terms of learning how earnings impact your trading. 4 different types of strategies they break down: the long straddle, the short straddle, the long calendar, and the ever esoteric short calendar. I don't really recommend a lot of you dive into that one. We've touched upon it, the reasons why in the past. It's not really the most retail or really advisor-friendly strategy out there. Right now, they are monitoring, looks like, about 87 long straddles, 37 short straddles, and 89 long calendars. Like they just put on some new ones, short straddles in Zoom, a long calendar in Best Buy, and another long calendar in ANF. So if you want to see that for yourselves, listeners, get all that detail. TheOptionsInsider.com is the place to go. Meanwhile, we have to keep going into our next segment. It is time for a little Options 101.
It's time to learn how to use options to manage risk and generate additional income for your clients. It's time for Options 101.
All right, everybody, welcome to Options 101. We know you advisors need a little bit of hand-holding when it comes to using these options. We get it. They're intimidating. They can be spooky if you don't know what you're dealing with. But there are a number of option strategies that are very advisor-friendly, very much tailor-made for this audience. We like to explore them in a little bit more detail in this segment. One of those we're going to touch on today is the cash-secured put. Now, you might say, what sounds weird. What the heck is that? What are we talking about here? It's a very popular strategy with this audience. You may be familiar with the concept of selling a put, just getting naked short a put because maybe you want to just collect some premium, or maybe you want to get long the stock. This is a variation on that theme, but a little bit more risk secured in terms of you're actually putting the capital up at the outset of the trade to backstop buying that stock. But also it means it's going to have a little bit more opportunity cost as well. Let's break it down. What are we talking about? Let's give you an example here. Let's go out to everyone's favorite XYZ, a name we've all made and lost fortunes in. XYZ, it's pretty frothy. It's trading for about $100 right now. You're an advisor, you're sitting there, you're talking to your client. You have a pretty sizable client. They like XYZ, but maybe not where it is right now. They want to buy it a little bit lower. Let's say in our example, they wouldn't mind buying it if it dropped, about 10 points. Let's say down to about 90. Let's say in our example, let's go out in 3 months. Sometime in the next 3 months, if it drops to $90, they are willing to buy 1,000 shares. So they're going to put out $90,000 for this trade. You're the advisor, you hear that. There's a couple of ways you can approach that, right? The way 99.9% of advisors would probably approach that is they would work a limit order to buy the stock at 90 or somewhere around that level, and then wait and see what happens. See if they get filled for their client and move on to other business. Now, we've all seen demonstrably over the past couple of years that working limit orders in a stock is risky. There is inherent risk there. If you're working limit order to sell a stock, you could miss out on the GameStop type explosions to the upside. Obviously, the stock could get annihilated. We just saw names like Snap and others this week get annihilated. So there is risk inherent with working a limit order in an equity. And a lot of people think you should be compensated for that. Hence, what we're going to talk about today, which is the cash secured put. Now, another way you can go about this is you could go out and sell a put option. Remember, a put gives you the right to sell an underlying security at that strike price through the lifespan of that option. In this case, we're going to go out 3 months because that's the time frame specified by your client. We're going to sell the 90 strike put, which again, you're going to sell someone else the right to sell that stock back to you at any time for $90 during the lifespan of that option. So you're effectively guaranteeing to buy that stock for $90 sometime in the next 3 months. In our example, you're not getting a ton of money for this. You're going to get nice round $1. So what does that mean? $1, remember, this is an equity option, so the multiplier is 100. So multiply that times 100, that's 100. And now tack on 10 because you're going to buy 10 contracts, so times 10. So that works out to $1,000 worth of income in your client's account. You might say, well, I'm getting paid $1,000 to work a stock order. That's pretty cool. I might want to do that over and over again. And of course, that $1,000, that $1 you're collecting means, of course, you're also lowering your effective buying price for the stock to $89 from $90. So there's a little bit of cushion there as well. Now, we'll get into what makes it cash secured in a second, but first, let's go out to Mr. Matt. Mr. Matt, sir, what are your thoughts on short puts, and in particular, this flavor, the cash secured put, when it comes to the advisor, sir?
Yeah, I was around before they invented the term cash secured put. That sounds fancy. We knew it as naked puts, and I'm not the hugest fan of naked puts. Naked puts is just you have no downside, and you have a limited upside. So I much prefer when I do it. I think it's a good strategy to do, but I think you should do it as a short put spread. And I think a lot, I chime into these, or I follow some of these YouTubers that are selling cash secured puts, and they now many of them have converted to put spreads. So I think that's a wise choice. So I'm looking at Apple 30 days to expiration. Often people sell the 30 delta. And right now that's trading about 410, the June 24, 135 strike. You could sell it for 410, 415's mid. Why not buy, so you get $415. If you were to then just buy the 120 put and do turn that into a put spread, now your income is still $300. It's about 118, but your downside you've cut by a third. So you're down. I'm looking at 3 standard deviations. There's no downside really until 0. But if we look at 3 standard deviations, 3 standard deviations in Apple down would be a loss of let me just do that calculation again. About $3,700. If you put that put on, then your downside's $1,200. So I like throwing a little put, just a little put on there, and now the amount of cash you have to put out to secure that is a lot lower, and you have a downside, because what often happens is it sounds great. Someone wants to buy Apple at 135 instead of 140. Well, the problem is when it goes down to 125, a lot of the thoughts that they had when they wanted to buy that stock at 135 are different, i.e. the market just crashed and everything's a lot lower. So, the logic isn't quite there for me. I know it's a popular talking point, but I'd rather do a cash secured short put spread. It accomplishes almost the same thing, in this case $300 versus $400, but you're so much more protected. Your downside's a lot better. So that's my feeling on it, Mark.
I could certainly see why you would feel that way, because as I mentioned, there is a sizable opportunity cost to this trade, not to mention, of course, the downside that Matt spoke of. That's the first and most obvious risk. If you're selling a put, in this case, on our example, at the 90 strike, you have effectively 90, or in our case, 89, because we collected $1. $89 worth of downside that you are exposing yourself to. If you're looking to buy a stock, that's kind of a risk you're willing to take on, obviously. So that's something your client will inherently assume at the outset of the trade, that once they buy it at 90, they're good to go from that price level. Now, what Matt's talking about, and Matt obviously concerned about that downside, which I clearly understand, and doing a put spread instead. So in our case, maybe we would buy the 80 strike put instead. So now we've limited our downside to effectively $10 instead of the $90 or $89 that we had before. And one of the other things people often balk at with this strategy is that it has a sizable opportunity cost. Remember, in this example, this was a pretty sizable client. They wanted to buy 1,000 shares, so almost $90,000 worth of stock minus the 1,000 we already collected, so $89,000. What I mean by cash secured is you are putting up that collateral effectively at the outset of that trade. You are setting that aside so that if the stock does cross your strike by expiration, you have the capital there to actually buy the stock. So in our case, we collected $1,000, but we're setting aside effectively $89,000. So you have to decide, and your client has to decide, whether that is worth the opportunity cost. Now, if you don't get filled, obviously, you're still keeping that $1,000. You could rinse and repeat this strategy. If you're going out 3 months, you can do this 4 times a year. So you have to decide for yourself and for your client whether $4,000 in this case is worth the opportunity cost of keeping that $89,000 on the sideline. But still, it's a sizable opportunity cost that you have to deal with. Now, sometimes if you're dealing with a lot of cash accounts where they don't have margin associated with them, this is pretty much the only way you could really sell a put outside of Matt's other example, which is selling the put spread. If you wanted to straight sell the put to use as a stock entry tool, then the cash secured put is one of the only ways you can go. So they are a little bit more capital intensive. What do we mean by capital intensive? Obviously, the actual margin requirement for a short put in a traditional brokerage account, that's going to vary wildly depending on your broker, on the type of account you have, the size of the account you have, the type of margin you have. There's a lot of different factors in there, but it would be a sizable difference. We won't get into it here. Maybe we'll save it for another show. But it would be a sizable difference, probably on the order of somewhere around, in our example, maybe $10,000 versus close to $90,000. So a sizable opportunity cost difference there. So again, I wanted to just put this strategy out there for you. You probably have heard of this as an advisor. It's become a very sexy type of strategy right now. People say cash secured put, so they think it's a no risk trade. But the risk is you're buying the stock at that strike. That's the primary risk. And so long as you're comfortable with that you should at least know that at the outset. And also there is the opportunity cost. There's no free lunch. You're getting $1,000 in our example, but you're tying up $89,000 for the lifespan of this trade. So again, there's an opportunity cost and there is a downside risk to this. So while it is in a lot of cases preferable to just working the stock order itself, most of the things we talk about on the show are going to be preferable than just working stock orders. But you can also, again, investigate that alternative. We have talked about selling put spreads on this show many times. I would encourage you to go into the archives of this program to look a little bit more into detail on that. You can look at Matt's example he just laid out in Apple as well. If you want a little bit more of a deep dive on the educational front, Options Bootcamp, Options Playbook Radio also have extensive archives dealing with selling puts and indeed selling put spreads. You can enjoy those as well. This is kind of just a introduction to the cash secured put. So if you don't want to just work a limit stock order, this is one way you can go about it. Just bear in mind it has some opportunity costs to it that maybe you weren't thinking of before you decided to go down this road. As we keep on going down the road of the show, right on into the buzz.
Busy financial advisors don't have time to follow the latest developments from the options market, so we do it for you. It's time to get the buzz.
All right, everybody, it is time to get the buzz. And Mr. Matt, one of the ongoing discussions / debates we've had on this segment, really since the onset of the pandemic, has been, hey, can this crazy volume party continue? We've weighed in on, a lot of guests have weighed in on. We have the latest numbers from OCC. We are eagerly awaiting the numbers for May. We're only a few days away from the May numbers now. The latest numbers we have from them are from April. April, once again, keeping that party alive, party rocking in the option space here with the highest April in history. So that's a good sign. 782.8 million contracts total cleared by OCC. That may not sound like a lot when we were talking about, 900 plus million in some other months, but April, a bit of a shorter trading month. And also overall volume up 9.4% year over year from April of last year. So that's a good sign. You're looking at the average daily volume right now through this point of the year. That's also up 4.2%. So that does seem to bolster the case that we will, barring some sort of, volume shocks, probably come in maybe somewhere along the lines of where we did last year and probably exceeding it a little bit. Mr. Matt, are you still on that tip, or are you kind of on the fade side again, sir?
I'm on the fade side, and here's why. I've always said that I think a lot of this option excitement and volume, has been Fed related. So, and I think that some people got hurt this May, and I think that the numbers aren't, even though it was a very busy month as far as volatility, I think it's going to be a little less than people thought. It's going to be still pretty decent, but I think it's, people are going to be licking their wounds coming into summer in a lot of ways. So I'm a little bearish. I mean, I heard, there's some bullishness out there, but I'm going to stay on my follow the Fed, and you'll see where the volume's going train, Mark.
Can't fault you for that. I was fading the volume train for the last couple of years. I've finally gotten a little bit more optimistic. Maybe that's, of course, the canary in the coal mine listeners that we're going to blow the doors off to the dark side in volume this year. I think Matt and I both hope that we do a lot of volume, because obviously that's good for the business overall. It's good for a lot of you out there, but it's hard to fight off the cynicism sometime. And Mr. Matt, the volume discussion was also very prevalent down at the big conference we alluded to at the top of the show. You and I both saw each other in person a few weeks ago, had a delicious dinner down there on the Riverwalk in San Antonio. We were attending the big options industry conference, the first in-person one since all this madness unfolded back. Actually, they canceled the 2020 one, so the last really in-person one was 2019. So a lot has gone on since then. It was good to see people in person again. It was good to see you in person again, Matt. There was a lot of great topics, a lot of great discussions, a lot of great panels What stood out for you? What were some of the highlights from the options industry conference this year, sir?
Well, of course, it was fun to get back, fun to see everyone. I love the cabana, and the swag was as good as ever. So, my kids are looking at my fine drinking cup here from NYSE and NASDAQ and everything. So, I mean, that was all good. And
I wouldn't know all that stuff is going to our listeners. I have touched none of it. I see a mountain of it here in the corner of the studio. It's amazing. The pile has actually grown somehow, and yet I will touch none of it, sir.
But, it was good to see everyone and hear what's going on. I mean, there's a lot of smart people at the conference. Everyone's working on some really interesting things. It was great to, you're rubbing shoulders with some of the CEOs and leaders of these, fine option related firms. And so it's really cool to be able to get there and hear them and see what they're working on. And so it was great to be back. And, the presentation, Henry's presentation, I remember working with Henry on his first one, and, he's gone on to bigger and better things, but he does a great presentation showing, when retail has come into the market in a big way, showing how, now, but, he didn't have any May numbers again, so I'm wondering how this is going to go. So I think May is going to be a little bit painful for retail. So we'll see how that looks. But it was a great conference. Good. It was great to see you and some of our clients down there and break bread, and went down with Molly, my wife, and so it was a really good time, Mark.
Yeah, there were a lot of subjects that were interesting out there. By the way, all of our pro listeners are listening live right now, and all you on the pro podcast feed, you already have access to pretty much a lot of the audio that we recorded for you down there. So you already hopefully enjoying that. You can already hear, if you like, Henry's State of the Industry presentation, which is something a lot of people look forward to every year. He really does a great job of crunching the numbers and breaking them down in some very interesting ways. He talked about the kind of onset of Robinhood and how that's really the zero commissions war has really just ignited the volume front out there. A lot of talk was about daily expirations at the conference, as well as you might imagine. That really was top of mind for a lot of people out there. Right now, it's pretty much mostly limited to the S&P. We are looking at some of the other indices getting that. I did put the question to the CEO of OCC, the Options Clearing Corp, a.k.a. the folks who take the other sides and clear all of your options trades for you. I did ask him about the prospect of maybe potentially seeing daily expirations in, let's say, an Apple or a Tesla somewhere down the road. He didn't seem too enthusiastic at that prospect. Let me put it that way. The primary reason they don't like it over there at OCC is their main risk factor they have is all these crazy corporate actions. And you don't see those in the indices. S&P doesn't declare a massive split overnight or something crazy, or a massive surprise dividend or an acquisition or anything along those lines. But you see that happening all the time in single names. So the prospect for them of trying to work out the settlement price, what they have to determine on an almost daily basis for some of these corporate actions, usually takes them a little bit of time to get that stuff sorted. So, yeah, he didn't seem too optimistic on that prospect. So if you're excited about the idea of, as Matt was talking earlier, his 0 days to expiration calendars and maybe doing that in an Apple, maybe slow your roll on that one a little bit. Probably not going to see that for the immediate future. Have a new options exchange on the horizon, the MEMX folks. Not sure when we're going to see that. We've been hearing about that for a while. So I kind of put that on the back burner. When we see it go live, that'll be interesting. I think we're up to about 18 options exchanges now, so it's a very crowded space. But intriguing stuff. Mr. Matt, before I keep going, we also did get the sentiment on some people, a variety of different people, on our options question. We've asked Henry, the Flow Master, on our network in the past. He's been mostly bullish about the prospect for options. He thinks it's going to come in maybe a little bit north of the level we saw last year, which is kind of along the lines I've been on for a little while now. Weirdly enough, the CEO of OCC actually kind of bearish on overall volume. So he's on the Matt train there. So that was kind of interesting as well. So we have a nice diversity of opinions on that. Check out some of that content we put up there for you. That interview I have with John Davidson from OCC should be hitting the network. And if you're on the on-demand side, you'll be getting access to a lot of that audio as well. Just it'll take a little bit. It has to go through all the various I's dotting and T's crossing before we can release it to the wild world out there. Meanwhile, though, you guys, speaking of wild, you guys are always wild. It's time to get some of your questions. It is time to open up the office hours.
It's time to answer your pressing questions about options. It's time to start our office hours. You can become a part of this segment by leaving a question on theoptionsinsider.com, emailing us at questions@theoptionsinsider.com, or via social media at twitter.com/options, facebook.com/theoptionsinsider, or stocktwits.com/optionsinsider.
All right, everybody, welcome to the office hours. This is the portion of the show where you guys can take the reins with your questions, your comments, your insights. We also have a question we ask you guys with our question of the week every week. If you're not following us over there at Options, I know most of you are, but if you're not, give us a follow and play along in our question of the week. This week we have another interesting and contentious one, very relevant for this audience as well. You know, we've been polling you guys for a while now on what you're up to in your broad portfolios. A sizable portion of you have said you're in cash now, kind of waiting to buy the dip. We've asked you what level you're looking to buy the dip at, and somewhere close to 30-odd% of you said you were looking at that 3750, 3700 level, which is one of the nearer term supports a lot of people have talked about in the S&P. So this week we're mixing it up again. A lot of you have also said you're waiting not just for the S&P to hit a certain level, but also for vol to hit a certain level to really trigger that capitulation in the marketplace. So I thought we'd ask you about that this week. A lot of you are waiting to dive back in, but what level does VIX have to hit to signal a concession in the broad markets? Gave you 4 choices, as we are wont to do on Twitter. North of 40, north of 50, north of 60, or north of 70. It has been very contentious, to say the least. We'll get to some of your responses in a bit. But first, Mr. Matt, first off, are you a believer in this concept that we have to see capitulation in the VIX first before the bear market can really be said to have run its course? Or do you think that's kind of a bit of an outmoded notion?
I mean, that's worked quite well in the past, but I think bear markets aren't all the same. So this one seems, I would lean to the lower end of this to see capitulation, but there's some argument to say that we've seen it, and it's just volatility for a long time versus a quick blast of volatility. It seems like volatility for a long time at somewhat elevated levels is somewhat of a capitulation. So I would say when we're gonna turn, it might be lower. Could eat my words on that too. But I watch my signals, and I'm seeing still there's a fair amount of worry out there, but it really feels like some of these signals are calcifying and might turn to the nice side, to the rally side. But we're not out of the woods yet. I don't think we're going to see that high just on this, at least in the very near future. So I don't know how long I would wait. Let's put it that way, Mark.
Interesting. So you're starting to scoop in here. You like these levels? Well,
I mean, protected, right? So when your other signals start to show, hey, it's somewhat okay to get in, from a protected way, I think there's something to do down here.
Let's see what our audience thinks. And right now, it looks like 40% agree with you, Matt. They say, well, the lowest level of our polls, maybe a little bit above what you're thinking, but they're saying north of 40 to them, with 40.2%, ironically enough. That's the level of capitulation they're looking for. Followed by number 2, north of 50 with 25%. And then the extreme crowd, the north of 70 with about 24.2%. And then north of 60. No love for 60 for whatever reason. Only 10.6%. We were on stage with one of the Monday Morning Live guys for the Vol Views last week, one of Mark's partners out there, and he was looking for VIX back to 80 from the 2020 sell-off days. So some people are looking for a really aggressive level in VIX before they will believe that the worm has turned out there. But you folks are interesting. Sounds like Mr. Bill Luby, who's been on our network a lot in the past, agrees with you, Matt. He was chiming in on our poll. He says he thinks the answer is none of the above. He thinks another garden variety 35 will do it for him. He kind of disputes the general notion that we need another big VIX spike, for the market to hit a capitulation bottom. It said it gets back to his slow motion capitulation / rounded bottom thesis. Something like the 2000 to 2002 sell-off is the model he's looking for here, rather than the COVID or great financial crash. So it sounds like, Matt, he's along the lines of you a little bit. He's looking for maybe a little bit of a more easy sell-off, or whereas you're looking for maybe a little bit of the worm potentially turning here, sir.
Yeah, like I said, I think that's what this feels like a bit more. Looking at our, long-term charts, there has been, they're all different, right? But, but definitely a few of them have turned without that VIX getting up that high. So that's what I'm feeling, Mark.
Let's see what the listeners are feeling. Let's go out to the live chat first. Mr. Unlimited says, the SPX is going from weekly to daily. That means Matt's appearances are going to go from monthly to weekly on the network. There you go, Matt. What do you say? The audience wants you here now on a weekly basis, sir.
Well, I appreciate that comment. We work hard here, and I love doing these podcasts and educational pieces. And, I agree. There's so much stuff going on. And we used to trade, and expirations used to come once a month, and that used to be just the busiest day. You used to go home and just face plant for a couple hours, I remember, and now they're going to be every day. One of the things, I was also talking at the option industry conference to some of the other folks. I was wondering if NDX is going to get more expirations, and it sounds like they are going to follow when the Tuesday and Thursdays, so they'll be next. So, and I heard what you heard, Mark, that they don't like doing a lot of these stocks because of the all of the announcements and splits and that. So it's a big headache for them, but the indexes are a little bit easier, and I think we'll see those a lot more. So yeah, I think we're just going to see more and more weeklies and daily expirations, Mark.
Well, that dovetails nicely into our next question here from TLDS. He says, with SPX moving toward daily expirations, will we see the other major indices follow soon? How does it change the game now that expiration Friday is gone and expiration now comes every day? Outside of SPX and indexes, what other products do you think we'll see dailies in soon? Well, we kind of just touched on this, TLDS. Doesn't sound like you're going to get your big equities anytime soon. I would not look for those for some time. There is a lot of work that has to be done behind the scenes. John at OCC admitted they probably will get there someday in terms of having the technology to be able to calculate that stuff almost on the fly. But for now, it seems like it's a bit of a bridge too far. So probably table the single names for a while. As Matt just alluded to, he talked to the NASDAQ folks. I've been hearing similar stuff that it does seem like where the S&P goes, the rest of the major indices will follow. So they will get there sometime soon. So if you like the notion of trading intra-week, or, your Tuesday versus your Thursday, or Matt's 0 days to expiration spread with a whole bunch of other legs going on around it, then you will have those opportunities, it sounds like, sometime soon here in a lot of the other products. Matt, is that your thought as well?
Yeah, and the other part of his question was, how does it change the game? I think there are a lot more volume is going to go to these shorter dated 0 days to expiration, and that'll help the liquidity. The quality of the fills I've been getting in SPX has been great. So I can't, versus how that used to be, it's pretty awesome. So, I think that's how it's going to change the game most. There's going to be a lot more strategies, you have to, people are going to have to go for a lot more minute data. So ORATS has exposed our 1 minute summary. So we're actually updating all of our summaries every second of the market. So you're seeing implied volatility change every second and all this stuff. So how does it change the game? The liquidity is going to be better in the front months. Going to be a lot more trading strategies in the front months, and you're going to need a lot more data that has a lot finer granularity. So it's a good question from TLDS.
All right. It's amazing how fast an hour flies by when you're having fun. Great questions, everybody. Keep them coming. Maybe we'll do another big office hours palooza, maybe a nice mid-year one, because you guys have been so patient sending in so many great questions. Mr. Matt, though, unfortunately, that music means we have come to the end of yet another epic journey through the world of all things advisors, option. Before we go, you kind of mentioned, I'm actually looking at it right now, sir. I'm looking at the new ORATS.com website, and yeah, got some cool stuff up there. If folks head over there, sir, what can they find these days?
I was just going to look at it because we were just about to put a new ORATS.com up. I don't know if they haven't even got it up yet. So by the time we're talking, by the time most people are hearing this, there's going to be a new ORATS.com showing off our dashboard. We have a ton of things coming, so it's really exciting on our side. There's going to be more risk-centric positions are coming in. Even, Mark, I'm going to leak this probably way too early, but maybe even some crypto stuff.
We had questions about stable coins. We didn't even get to those. We could touch on that again soon as well.
There's so much to talk about. We probably need to move up the advisors option every week. TLDS is right.
That'll certainly please our audience. So yeah, I'm looking at it right now, listeners. A lot of cool stuff. The Wheel Web platform and a whole bunch more to check out. You know where to go. ORATS, ORATS.com is the place to go to begin your journey to the dark side. Give them a follow on Twitter as well. A fun handle, Option Rats, all one word, RATS there at the end. And you also know where to go to check out all the content from our friends over there at the Options Industry Council, including, I'm pleased to say, the return of their own podcast, The Wide World of Options, was on hiatus for the better part of the pandemic, but now it's finally back. So if you want more information on a lot of these strategies and a nice basic overview of how to use options in your or your clients' portfolios, optionseducation.org is the place to go to learn more. We have to get on out of here, but don't worry, all of our cool cats in the Pro Club, settle in, grab a beverage. We got a lot of content in store for you today. I'm going to have no voice by the end of the day, man. The producers are working me today because we have a double dose of Options Boot Camp coming up in a little bit less than a half an hour now. Myself and Mr. P will be diving into all of the great educational stuff you guys want to talk about out there and a whole bunch more. And then, if that's not enough, we'll be back for a double dose of OPR. One of those will be live to tape, but the other will be live to you folks here. You get a live huddle with myself and Mr. Overby as well. So if you haven't had enough question asking from today or from our great pro Q&A session yesterday, you got a few more chances coming up on Options Bootcamp and Options Playbook Radio. So you have a question, get it into the live chat now. We'll work on getting it onto the shows. And then, of course, back again for TWIFO and the Option Block on Thursday. And then, of course, Friday, Ball Views. And for all you cool kids in the Secret Club, back again for Options Oddities. And then, of course, back again for this program next month, another episode of The Advisor's Option. Stay safe out there, everybody.
The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the SIBO over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit ORATS.com or email Matt Amberson at matt@orats.com. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.